I think we're going to be on time. Here we go.
Yeah, we made it.
It was tight.
All
All right.
right.
Live on time. Here we go.
Okay, we'll wait for a few people to get in here, but as we start, I think investors are probably happy to see August end, as it was one of the worst months we've had so far this year. Although, unfortunately, September is not historically much better. It's actually the worst. So we'll see how all this plays out in the coming month. And just to begin, we wanted to update with George's stance on where he sees the market.
Yeah, I think I've been, and I mentioned this in my newsletter. I think I've been fairly slow to like come around the bull market, this like little bull run. I did really change a lot of my outlook in terms of the model portfolio because that's a larger one, and it was skewed a little more short. I made it a little more neutral to end last week. Man, these glasses have weird reflections. I had to figure that out. But yeah, basically what I was seeing was I went to neutral. I went to like 4 longs and 4 shorts in my newsletter portfolio, which tends to be more conservative. Like the whole point of the model portfolio is I take a little more risks. I move away from stocks I'm like heavily researching, and I'm just like throwing things in straight up based on the signals. And in some ways that's great because it shows off the signals more. And we are, in many more investments, close to 150, close to 30% up on the S&P 500 for like 3 months, which is excellent because we're cycling them a lot more and it's a different type of portfolio. But yeah, I went neutral and I was 3 longs and 3 shorts last week. So I'm slowly becoming more bullish. But it looks like that was the right read. And it looks like the market's a little down today, a little bit more, traditional September. It was a very light trading month last month, and especially towards the end. The end of August is like one of the slowest trading months. So like that's or weeks, and August is slow in general. And just like personally, like a lot of people on Wall Street, I know that's like the one month they really like coast a little bit. The rest of the year is hard, and they're basically making up for it in maybe 1 month of easier work, and they're still sort of working. You always kind of have to work and look at the markets and maybe call your important people on Wall Street. But yes, basically what you're looking at there is maybe we don't need to take the bull market that seriously, or the bull run, because it was so low volume and it might just have been a little easier for bulls to control. And shorts are harder and require more work to monitor because bankruptcy is like, I guess, creates a max 100% loss. But most companies that people invest in, they're not too worried about bankruptcy. On the other side, shorts have a technically like unlimited loss. And it's not that, it's not necessarily that difficult, especially like a short that is trading at a lower price to, lose 100% of your value relatively quickly. So you really have to monitor shorts closely, which means like bear positions, more on vacation, are a little harder to do. Now, the flip side is like some years bears use August as a time where there's less volume to more easily control shorts. If they are working and they're like, hey, I'm going to put on these short positions because it's a good time to tank these prices and get good entries. So that's certainly a possibility, and that might be what we saw kind of at the beginning of August. But tempered bullish there, and that's kind of what I did. Like even for me to split, half and half, and I mentioned in the newsletter, half bulls, half bears. That some of the things I've been looking at in the macro end, I'm still really not comfortable with an extended an extended bull run. Based on seeing like the way that Buffett has been like moving increasingly to cash. And I did want to explain, because I was answering for for someone this past weekend, talking about 13F filings. And, people say like Michael Burry is short, right? And they even talk about when his options expire. And, that's kind of an uninformed thing, an uninformed data point to weigh. And I'll tell you what, by the time 13F filings hit, which is, by the way, the only time you can see options data in 13Fs, and that's what people are taking. 13Gs are the other institutional filing, and that's basically if you have 5% or greater of a stake and you have like, kind of a material change in that stake. And those you have to do instantaneously as a disclosure and a large shareholder. similar to insider transactions that get reported immediately. But when you look at 13Fs and the Michael Burry position, as I mentioned, options have to be in 13Fs. What you're dealing with is like best case scenario, you're getting 6-week old data, right? And then that 16-week data, the 6-week data ages because you basically have a situation where 13Fs are quarterly filings. So by the time you get them, it's about 6 weeks after they filed, give or take a little bit. And then they get months old. So a lot of the times, actually, by the time I started reading this Michael Burry stuff, a lot of them were already like 1, 2, closer to 2 months behind the actual filing. And the important thing to remember about all these things is lessons that I teach kind of all the time. The first thing being that sometimes these positions are just what institutions want you to see, right? By the time they report, they could say, you know what, we know these positions are going to go out. I want to appear on more long than short this. I might want to buy a bunch of call options on something I'm actually short to make it look like I'm not short and cover some of the shorts before to make it look like I'm net long. And that's just an example, but they could file their 13F and completely change their positions the next day, which is why this Buffett data point is relevant, because that's more true for funds that do a lot of options trading, which there's a substantial amount of unlevered funds, or just like long only unlevered, different ways to say that. But options are leverage transactions. Shorts are leverage transactions, which is just basically means they're derivatives. They're not, a short specifically is like a loan instrument or a contract. It's not necessarily like a raw security. So in those situations, essentially what you're dealing with is funds that could turn over really quickly. So the 13F data for someone like Burry, you don't know if he's already shorted the market, collected his gains, and out of that position. So people keeping on repeating that he's short kind of shows that they're uninformed, unless they're like, I have inside information that he's still there. And even then you have to question why or how, or, you're getting that information. Conceivably it's possible because fund managers like Burry, anyone to their LPs, the people that, invested in their fund or that manage, that are part of the fund, they might be honest about those positions. So conceivably it's possible that people get that data, but you always have that issue on Wall Street, which is just you might be getting it, they might have that information, and you might just have someone intentionally telling you incorrect information. So you have to be careful what you weigh there. But anyway, to transition back to Buffett, someone like Buffett, you don't have to worry about that as much with, because he's a long-term holder. So he's not playing games with his filings. He's not oh, I better file a 13F. I better see what's going on here. He doesn't do that. He buys and holds, and he's not playing games. So when 3 quarters in a row, he's moving to cash, he's consistently selling equities, that means pretty conclusively that he expects, a recession to come. He expects better prices in the future. And that's by the way, I mentioned in my newsletter, a very reasonable thing to do if you're bearish. Yes, we talk about hedging with SQQQ or another inverse index. We talk about shorting, a percentage of your portfolio to hedge. But it's very reasonable to just go to cash or take a substantial amount and go to what's called a market neutral strategy, which Vanguard has a low fee, issue of that is just moving to something that is designed to, maximize a reasonable conservative take in volatile markets. Bear markets are obviously a different thing. That's more of an inverse. But market neutral is nice to just hedge and have your money not in cash somewhere, and maybe you can make some money in a volatile market that's not a straight bull or a straight bear. But the important thing, and one of the interesting things, and it might be a good one to transition and kind of talk to our next topic. But Airbnb is a little later. Maybe we'll do that before. But one of the things that Buffett is buying is, home builders like Lennar. And one of the things I've been thinking about and talking with some people around, because, I have people that I talk to that I get opinions from as well, to just like see like, hey, does this make sense to you? And one of the people I was talking to, I was just like, well, why is Buffett buying like these home builders, right? When I'm worried about the personal credit crisis, and it's just like, well, a lot of the theory is that the personal credit issue coming is going to be more about consumer spending and not necessarily about defaults. We haven't seen enough evidence of defaults. And that's something where, we're basically talking about, like we're talking about, that, some of the banks, like we talked about last week, we're kind of getting hit or coming back and kind of talking about why banks might be getting hit. And we'll circle back to that a little later. Because I did want to talk about this within the scope of Buffett and Airbnb and housing stock. And, we've started to see a lot of like obviously large companies buying single family homes. We've started to see there's this very interesting story developing in Northern California where I think $800 million of land has been built in, and basically like this, like it's rich tech people that, basically want to build a modern city, like for wealthy people outside of San Francisco. And that's an interesting way to look at it. And I'm just saying, well, even if there are defaults, there's a story here where home builders are still a growth opportunity. And I think a lot of that is because housing supply has been a problem. And that's part of why we have started, and this is where Airbnb comes in, started to see these anti-Airbnb laws. And some of it is just corruption, hotel lobbies, real estate people just like not liking that and want to do what they can to, see it go away. But, absolutely, I would say, building new homes is an interesting business, especially as we have all the like modernization, smart homes. Even for all those defaults, there's a story. I think Ohio is another market where it's happening. There's a story where, people are building more modern homes, more housing stock. And, some of these homes that are, older and, neighborhoods that have perhaps become less desirable just have defaults. Like it is possible that those homes just like really decrease in value in exchange for these, newer homes, and the newer ones, perhaps in more thought out communities, better locations, perhaps even better designed roads for traffic, things like that. And you're like, work from home has made a big opportunity for that too, where all of a sudden it's not necessarily about your commute. You can go a little farther away from where you live, and just, buy a newer home that might be a comparable price and more modern because it's just like in a slightly less central location. And I think a lot of people could be making those choices. I'm going to segue all the way to Airbnb. And, obviously, one of the reasons we went short Airbnb was the housing law in New York. And September 5th, it hits today. Already a lot of listings were getting pulled. For me, that's a concern. And I might look for an entry point to short Airbnb now again, because it just got added to the S&P 500. And, for the first time, we actually took a bigger aftermarket loss on Airbnb, because normally, for people that don't know, we do in our model portfolio, we do Friday close to Friday close because it's Sunday letter. And we're essentially like, we don't want to use aftermarket because plus or minus, sometimes a single stock will trade post-market that's above the market price or below. And that's not a good reflection of market price. So we don't do that on both sides just to maximize our accuracy. And we basically take the close the market price. But we actually voluntarily, even despite that's not our reference point, took like a 5.5% additional loss on Airbnb because it moved after market. And that was because it moved up after market. And that's because it got added to the S&P 500. And that's something that is really hard to predict. I actually have in my past worked on those predictions for McGraw-Hill Financial as an AI test for them. So, which is the S&P parent company. So I actually do know a lot about the index ads and how hard they are to predict, even if you have all the good data. But it's very interesting. And I do think it, like, for people that want to watch it, I do think it's going to open up a good short opportunity. I'm going to watch it for the next 2, 3, 5 days, because I do think anything that gets added to the S&P 500 is going to be immediately bought up. And for those that don't know it, it's because ETFs have become so prevalent. Something gets added to the S&P 500, all of a sudden, all of the people that own, not only is it getting bought into like SPY, which is that, obviously it's a lower allocation when it first enters, but there's a lot of ETFs that are just buying whatever goes into the S&P 500. You have to do it for risk rating distribution. So pretty much anything is going to go up when it gets added to the S&P 500, Russell 2000, any of those big indexes that people trade, because not only is there demand on the ETF side, but also there's momentum trading going into that. So that's just an interesting case study for, Airbnb and, how I would even relate it to like what Buffett is buying. But, the fact that Buffett is buying, we're going to keep our eyes, like, we've been avoiding real estate because we've been worried about the personal credit crisis, but we might be looking for, a few things on the home builder side that might be interesting in the coming weeks. Because I did do more research on that, and I do see that kind of bull case, especially longer term.
So you answered one of the questions I was going to have, which is why is like Airbnb being added to an index so bullish for it? Because it moved immediately, but I guess because just there's a constant buying pressure at that point. But then I have one other.
Well, why is it being added? It gets added because, like, actually they do not reveal their formula. I probably know more about this than a lot of people because I've had some rough conversations about the edges a bit. But some of it is a manual decision. Some of it just like market cap. And just so everyone knows, there's larger market cap stocks than the smallest market cap on the S&P, plenty of them that are not on the S&P 500, because some of it is about, demand and their own growth projection for the business. And obviously people are bullish on Airbnb. So there is some of it is like their own, I would say, growth formulas. I don't know, but by talking to them, it seems like some of them are just like, there's a decision point at the end where they'll look at it, and then they'll just be like, you know what, Airbnb is a hot stock. We like it. We think we like the growth projections, and they'll just add it. Blackstone was the other one that got added. But yeah, it's very interesting how that's chosen. You're going to get a lift, and it's very, very difficult to predict. And I wouldn't we don't deal in post-market for the newsletter, really the model portfolio, because it's difficult and it's hard to get a really accurate price, especially for larger shares, and it's hard for people to duplicate. I don't want to send updates after market. That being said, if you ever see right when news drops about the S&P 500, it's not a bad idea to trade that stock immediately, because we can look and even at the end of post-market, Airbnb was up. We got out at up 5.5% at the end of that. But if we had got in early, there was certainly a better opportunity. And you can take a look, but it's already up 8%. So we're getting on at least 2.5% over that. And people had opportunities. It is never a bad idea, even if I'm bearish on Airbnb long term, to just be like, hey, if you see that news, buy it. That's a really good opportunity to clip a quick amount. You have to be aggressive with your stop losses to make sure you don't miss out if people, it's just basically a bunch of momentum traders getting in and getting out. And not bad to watch net option sentiment, by the way, to get information on that. But yeah, basically, that's definitely an important thing to look at.
All right, so before we move on, we have a couple people in here. If you guys want to ask us any questions, feel free. We're happy to answer any questions you have every week. So just comment in the live chat and we'll look at them and answer them. Okay, so before we move on, this is the last question I have. So you were mentioning the 13F filings and how they're not very accurate. And I think something that would be illuminating for people to hear is that that's because the information that you're getting there, which is weeks, months late, you already saw in Prospero live. You're just getting the same information refurbished later when you already saw it. And so there's no reason to act on it when you're already way past it within Prospero app.
Well, it's a little different. What I would say about 13Fs is you can see specifically who's buying, which is highly rare. We are obviously looking at trades and institutional trade signatures, like we say, but who is buying is very important. Like one of the things I'll look at is like I'll go look at Sage Tracker and Webull. And by the way, don't put your money in Webull. It's just like Robinhood, only your information is going to China instead. And like there are very looser securities laws, so like they probably don't even care if they're just like straight up like taking money from you in terms of payment for order flow. Like Robinhood is a little more careful. But they might also be spying on you, and I accept I'm being spied on. I use TikTok too, whatever. I'm probably being spied on in various capacities and by various governments. But I always look at Sage Tracker because it organizes you all in an easy interface. I pay like $2 extra a month for it. And it shows like the most sold, the biggest holders. The layout is actually very good. And that's just looking at 13F files. So who, like, and just to recap, and this probably is going to make a good short, the people that you are happy about like being new purchasers of, Two Sigma, Renaissance Technologies, 0.72, Cubist, which is a 0.72 offshoot. You definitely like those, seeing those in a large holders. Those are kind of some of the most, I would say, advanced funds. Now, because they're advanced and they turn over their positions a lot, it's not necessarily as safe. But like the flip side is like if you look at Vanguard, I never care about Vanguard. Like State Street, I never care about BlackRock, because like a lot of that is just like allocation. It's not a great indication if they're coming in or out or whatever. A lot of that is probably just like more so about allocation than any kind of like bull or bear. Like, and it's the total flip side on like Renaissance, whatever, like they're not allocating, they believe the stock will go up. So it's important to look at like net, like when you look at that, or when you look at like their positions moving, like, yes, they could completely change their positions, but like something like completely selling out of a position or paring down a position or things like that, they all give different information. But those are kind of my like watch list. I also like to see D.E. Shaw on the same side of the trade that I like. So whether that's short or long, buy, like, those are some of the most important ones to me. But feel free to ask me. I can make a list, like a longer one. But that's really important. The who is there. But like obviously it's still old. You have to couch that. But even with couching, I would rather see Renaissance Technologies like going the same way as me than not going going the opposite way.
I have a question. If you did see that they were going the opposite way as you, would you immediately react to that, or would you just reassess your position?
I almost always don't trade opposite like Renaissance Technologies. Like the one exception is I might see like Two Sigma on one side and Renaissance Technologies on the other, and just be like, well, neutral. But like I prefer, and like when I did my big like report on ENVX, like one of the things that I pointed to was 0.72 Renaissance Technologies and Two Sigma all being long that. So it reinforces strongly. Like if I'm just like looking at something and like, hey, it looks interesting, and I like see that kind of thing, I'm like, done, we're buying.
All right, so that's great information for people here. Hopefully that provides some value. And we wanted to hit back on the banking sector a little bit because we talked about it a little, financial services last week in depth, but we missed two of the big giants, which is Visa and MasterCard. And I wanted to circle back around and get your updated opinion, but also I feel like those stocks or those companies might be in some trouble with, Apple going out finance, Square, Venmo, all these. It seems like there's a lot of people vying for this transaction of money. So how do you feel about them?
Well, one thing that's important to note on that particular front, some of these new places are still like cutting in Visa or MasterCard or whatever on like their fees. Like I believe like sometimes I just like do this. I like tested like Venmo's like I think it's a debit card, and like that was a Visa card.
Okay.
So like it's not necessarily mutually exclusive. I think PayPal has a MasterCard too. Like, so it's not like straight a PayPal card. Like
it almost benefits them.
Like some of these infrastructure, everything like that is still like going through. Granted, the bigger business is actually holding the credit. But these things aren't being taken out. And MasterCard is one of Prospero's like favorite stocks. Long term. And like something like talking around, and we're going to talk around the banking issue a little bit, but there's a lot of angles in high interest rate environments where we haven't faced like a lot of defaults yet. And it is going in that direction and they might be coming. Like you're actually talking about higher profitability for these companies because higher interest rates mean, you're collecting more on debt, you're paying more like, and even the start of like having some like level of delinquencies where you're giving like late fees without like a lot of, defaults. Like if there's like delinquencies and payoffs, you're still talking about like profits increasing. So that's an important thing. And what makes the credit landscape a little complicated because, some of these things you do see profit increases before you start to see defaults really cutting into that. And in terms of defaults, like one of the things that we have our eye on, we mentioned in the newsletter, like the beige book, which is just like a report on, asset mixes, things like that for banks that like when I worked in non-performing loans, when I worked in like that data is actually really good because like that data you can actually go look at banks, bank reports, even, obviously more on the macro, like, overall how like credit performance, where assets are, like all that is like really like Wall Street is ingesting that and immediately putting it into their models. So, obviously that's something to know. And like, it's like kind of what we talk about a lot of times, like, no, you can't instantly put it into your models, but the better you get at like looking at those numbers and being like, oh, these are the potential consequences. It's super important. And then obviously Friday we have a big personal credit report. And that's why I advise like, if you have any exposure to like, especially retail stocks, I would take a long look at making sure you look for 3:00 on Friday when it goes to after, because it's possible that report can really scare people, or this beige book report. And like, especially anything that touches consumer spending, might be affected. And like, even something like, Douglas Elliman, right? Which we're short right now, like one of the lowest things, like, we talked about real estate, housing stock, blah, blah, all that stuff. We are going into a period of the year. The summer is like prime leasing. And then with people being like shorter on money, maybe less willing to move, the rental market could really slow down. And that kind of thing is like, you wouldn't consider that like retail, like it is a little consumer spending, but it's good to think more broadly about these things. And this is where just like getting trained in value investing and thinking about these problems is an important thing, where you're just like, you just got to be like, okay, people have less money, like, or might have less money soon, might be more strained. Like, what products do I think are the first to go? And like, yeah, I think anything like, retail, one of the stocks we shorted right now is like more of like a sporting goods stock, even though it's doing pretty well today, but that could like catch up later in the week if like people are worried about that kind of consumer spending. But like I made the difference between like a stock like that and a stock like Tesla, where it's like, yeah, Tesla's doing really well today, like because it is officially like a consumer cyclical stock in the sector. However, like it is also an AI play. So like you have to look at that complexity where like, yeah, if people can spend less money, like I am a little less worried about something that is like an AI play in this industry than something that is like just selling sporting goods, which like I feel not like, yeah, some people have to buy them, but like, are you going to buy that new hockey stick? Like if you're short on cash and you already have a hockey stick, no, like you're going to buy a basketball or whatever you want to use. Like, you're probably going to just like wait and stick with the one you have until you have more money. That's the kind of thing that like is something that I could see easily cut. And like, yeah, you kind of have to look at that. And that's one of the reasons, to segue a little, why I think Amazon has continued to do well, even as some like consumer stocks and consumer spending has been hit, because like you might go grocery shopping, right? Normally, and you might say, hey, I have less money now. I'll just buy like something from Amazon. I'll buy, like a protein shake or like something like that. So like, you might be buying less things on Amazon, but you might be substituting some of the things you normally buy on Amazon, like that new, like that new electronic thing or whatever. You might just substitute that for, food or like more like consumer staple things that, you just need. So that's kind of like an interesting way to look at it. If anybody has questions about that, that is a great thing to get questions, specific products that you might see, like how I would view it. But that's something that you just kind of have to become practiced at, where you like go through cycles of this and you say like, oh, like what is the relationship between consumer spending decreases? And like one of the things that I actually learned from working in mortgages, and just like a little thing, if you want to think about like cars specifically, car payments are the last thing to go for people. Like people will stop paying for their homes. Credit cards are first, then homes, traditionally, just like broad strokes. You stop playing your credit cards, that's unsecured, and there's not really any recourse. Like, yeah, and people might try to like hurt your credit score, like a weird extreme case, like repossess the goods, but I feel like that's more like media. Then homes in broad strokes, but last is people's cars, because people are just like, hey, I might get foreclosed on, like whatever, I'll deal with that, I'll find a new place. But like, people need their cars, like especially if they're commuting to work, like in like a lot of like jobs that are going to be like more affected by this. Cars are very important. So like that's just a really good example of something that I've learned, where it's just like, people that are in car loans, people that are in cars, like even if people's spending is lower, like I worry less about these kinds of problems affecting cars. Like obviously there's other things like higher gas prices that I would expect. Like all of a sudden people might buy different cars, or they might, they might just say like, hey, I'm going to get rid of my car and like start like biking. But yeah, there's little nuances like that that are very important that you just like get from, an interesting thing about like machine learning and tying it to human thought, which is, how machines learn is actually the same way, learn to predict things is the same way we do, which is like you need a forecast and an outcome. So you might say like earlier on, like a younger version of me might be like, oh, like I expect car payments. So like I expect car payments to go down, like default more. There's, economic troubles, personal spending, and like I have that prediction. And then it doesn't happen. And then I'm just like, well, how did I get that wrong? What variables did I miss? Right. And that's the same thing machine learning. A computer going back and doing that, about being like, oh, I made this prediction wrong. What information was I weighing too much? What information did I need to like weigh more? Our brains do the same thing. And like, for those that don't know, neural nets were modeled after kind of like the non-linear thinking and the way that like different parts of our brains will like process and do like, a lot of, like, not to get too specific, but a lot of our neurons fire depending on different things. We've started to map that more. And the link is like you're basically trying to mimic a lot of the same kind of behaviors in non-linear, like basically problem solving, like within matrix multiplication in math. And that's how, neural nets kind of work. But that's the reason that neural nets are like black boxes, because it's kind of just like, similar to the brain, firing a bunch of neurons like that we see are like lighting up and doing that. And like, you can think of it similarly to like a state space, which is like a predictive area of data. But yeah, I've always found that since I've learned that and like kind of put myself to it, and like I annoy some of my friends and people in my life, or some people like actually find it quite entertaining. I'm very good at predicting like various things, because I am always trying to predict things. And basically what you need is to predict something, have an outcome, analyze the outcome, and you'll get better. And then there's like a concept in learning, and there's actually something called like, there's a book called Super Forecasters about this. But there's two popular books, like Dan Kahneman, Thinking Fast and Slow. Different people talk about like 10,000 hours of learning something, but like you could become an expert at forecasting by just doing that, by just holding yourself to do it and do it in the market. Start just being like, I think it's very stupid when people make stock price predictions, because like, I think that's too big of a slice. Like take a smaller slice, try to predict like if sales of a company well is going to go up, and maybe where it's going to hit based on a deep knowledge of how their business works. Like I talked about Eli Lilly, for example, in the newsletter this week, and how pretty much 1/8 of their revenue was one diabetes injection drug this last quarter. And I did a little example of how I like look at things like that, where I said like, oh, actually Medicare is now, they did their first like 10 price negotiation drugs, and 4 of them were diabetes drugs. And that might be something where, as a modeling exercise, I might say, you know what, I'm going to forecast them with 500 million less in revenue 1 year from now, because there might be like a 50-50 shot that drug goes on their list and they lose profits. That's a very I'm not ready to do that. That's just an example of something that you might do to analyze a business and get better at predicting things. And I would say what I see all the time, and that's kind of like the antithesis of this, is when someone's just basically like, oh, NVIDIA, and I do this, and I'll use this example because I think these NVIDIA people are especially annoying and slow to understand what they do and don't know. And it's like, oh, NVIDIA is going to go up, and then it happens, and they're right, but it's just like, well, you weren't properly understanding the potential risks and the downside risks there, and you are actually encoding that you're good at that prediction by being like, oh, I said it would go up and it did, but you don't actually have there's nothing behind that. You're not making an equation.
Fooled by randomness?
Yes. Oh yeah, I talked about that. Fooled by randomness. You got to know if you're smart or lucky. And you are lucky if you can't explain exactly why. If you can't be like, this is NVIDIA's business. This is why I'm forecasting it up. This is why I actually find the risks to be negligible. And you've actually put numbers to that. If you could put numbers to that, tie it, eventually tie it to how those numbers have related to the price, then you potentially have a real prediction. If you're just basically hey, people are buying AI chips and NVIDIA is going to go up, you are not a predictor. If you're a guesser, and that's fine. It doesn't mean what you did was a bad investment style, because there is some logic to that. But it does not mean you know how to predict the price of NVIDIA stock. And there is an important distinction there.
Now, staying in the semiconductor sector, we mentioned Instacart filed for an IPO last week, which we did not like the prospects of that. We have another company, ARM, who filed for IPO. Their price is expected to be between 47 and 51, and they're going to have over a $50 billion valuation. So can we get your opinion on ARM?
We didn't talk about this. You're springing this on me.
Oh, my bad.
And this wasn't on our. I'm pulling it up because I
know a lot of people in the financial space really like ARM, and I think it's supposed to be like a competitor to NVIDIA. I'm pretty sure in China.
I'm reading about this in real time, and you'll get to see my process. ARM, this would be the biggest technology IPO of the year. An onset from Russia's invasion led to a massive slump in tech valuations last year. I'm trying to figure out, what does ARM do? Oh, here. Here we go. We're doing this live. We're doing a live analysis. I'm pulling up this Instacart, talking about that. Let's see. And tech valuations are down. This is what we talked about. ARM is. I'm trying to figure out what specific. Do you know what kind of chips they make?
I'm not exactly sure. I just know they are a supplier of some the biggest companies in the world, but I'm not sure which exactly.
We're gonna figure this out. We're going to because to talk about it, there's Supermicro, right? Which is making some designer chips, but designer servers. That's growing pretty fast. And that is obviously a favorite of ours. Then you have something like NVIDIA that a lot of people don't know this. They don't actually manufacture chips. They just design, and they buy chips from Taiwan Semi, some other places. But here we go. We got some specifics.
CPUs.
Okay. Designs. Oh no, that is not a company. That is we might have to
Hey, Lewis, back next week.
We might have to come back because I don't want, like, I'm like looking at this. These are actually CPUs, it looks like, which are NVIDIA's GPUs. And just so everybody knows, GPUs, and the reason they work was like we might as well bring it full circle on the matrix multiplication. GPUs were actually designed for games, and when you're creating simulations of worlds, you actually do a lot of the same matrix multiplication. Is obviously, like we've discussed, like the more advanced, like if anyone wants to look at GANs, generalized adversarial networks, we've talked about them in the past. A lot of the cutting edge stuff now is actually running simulations. And so that's why GPUs are, like, even though they were designed for like matrix multiplication, simulating worlds, like a lot of like our most advanced stuff is going more to simulations. But even before that, neural nets are a lot of matrix multiplications, as are simulating worlds for video games. So GPUs weren't designed for them. CPUs are the classic computing technology. And some people say, especially with algorithms, efficient algorithms, CPU processing could be the future of, some of these AI apps. Now, some like NVIDIA purists and everything, I've been like shouted out of an NVIDIA kind of Twitter live space before, and not because, like, some people like don't understand the distinction of me stating like something as a risk versus being like, no, like that's not even the biggest threat. Super micro is a threat. Like, people make their own chips, and I'm just like, well, it isn't a complete non-threat, right? CPUs, but yeah, it looks like we'll answer it more next week. But it looks like they have some more efficient processing approaches for CPUs, which does tie to what I'm saying. Like, AMD has talked about making a lot of custom algorithms that they can use CPUs for AI applications. That hasn't really come to fruition. But I'll read more. If ARM is a more legit challenge for that, that is a threat to NVIDIA for sure, and a huge potential business. And I'm guessing there's a little bit of that. I do want to read more of it, and we'll follow up next week.
The last thing I'll say on this, before, when I was trying to look up stuff to figure out what chip they make, I see an article that NVIDIA tried to acquire ARM for $40 billion in 2020. So that's an interesting tidbit of information. I think it got blocked. I forgot about that. I think I remember seeing that, but so we'll come back to that topic next week.
Yeah, I mean, they have such huge market share, but I would say that last thing about NVIDIA is, yeah, like, it's possible that means NVIDIA is worried about CPU processing coming for their like AI, and a lot of it, just so you know, I'll just do one more deep dive for anyone that wants to be more educated on this stuff. In GPUs have these CUDA cores. That's just like a specific name for, the types of processing that they do. And there's something called low-level programming, which is basically like how you route code into, something that needs to be processed, right? And NVIDIA, one of the things that they've done really well is not just building the chips, but actually built excellent software. Like the newest thing, NVIDIA, I'm actually in this Inception program for them where they offer to like make introductions and do various things. They actually got me an AWS credit, so that was great. But one of the things that they've done excellently is actually abstracting, taking care of the low-level programming for people, because before you wanted to use a GPU to run a neural network, you were running the low-level code yourself, and that was a complete waste of time. Why they've grown so much is they've written a lot of that code so it's easier to interact with, and one of their newest things is actually for traditional, they're trying to go the other way too. It's called levels, and they're actually taking stuff traditionally routed to CPUs, like database operations versus like algorithm programming, and actually made that like scaled up and run more efficiently. So they're writing newer low-level code to do that. But it goes both ways. And that is the interesting part of this. It's actually algorithms and algorithms like routing things to the proper place that enables NVIDIA chips to do so much heavy lifting. So if ARM has figured something out, I imagine they did, that could be big, especially if NVIDIA was trying to acquire them. I didn't know that. So that's something that we definitely will follow up on next week. And the one other thing that I want to say about this that will probably make this low-level coding example a little easier there's an amazing story about Google that I love. And Google, the way that they're actually able to like move forward, processing a lot of things faster, is they had, I want to say the first, but certainly by far the most effective um, database, something that is now called BigQuery, that like made Google Cloud as a provider and got me on Google Cloud way back in the day. Because I used to run joins in SQL, so like big data sets, millions of rows, basically being like, oh, I want a personal credit data set about people to map to their loan performance history. That's called a join, because they have like, those are different data sets. There's like a customer ID that they join under, right? And basically these huge data sets could take like 6 hours to join in SQL, because those are running what's called like a single thread on a CPU, or a GPU can have a single thread. But anyway, like, CPUs have something like 8 cores, 16 cores. And basically like when that join was taking all day, it was running on 1 core of that CPU, right? What Google first did for themselves in a database that I believe it was like the late 90s, early 2000s, and they really like pioneered the speed, it was called Dremel. And Dremel, they finally were like, oh man, like this is like 10 years old on our technology. Like people would probably want to buy this. This is really helpful. They made BigQuery. But how Dremel worked and how BigQuery works, and everybody does it now, is like instead of a join that is just basically like going like one by one, like customer ID, grabbing it, joining the data, blah, blah, blah. It could do that fast, but it was going one at a time. And so that's why it was taking 6 hours. Now, BigQuery, instead of doing 1 row at a time, it sends it out to thousands, potentially millions of cores on computers. You can think of them as computers, servers, but basically like a server might have 20,000 cores, right? So it's sending them out to a server, multiple servers. And the first time I ran that 6-hour join on BigQuery, it took 23 seconds because it was doing that. And that was before I knew how it worked. And I was kind of just like, I actually checked thousands of rows of that data set because I thought it was like witchcraft. I like it. Anytime I don't understand something in computing, that's the best thing to do, is like just a tip for someone who's a very good like data scientist and has worked with like lower level things in Excel and things like that, where I had verification systems. But I like looked at 1,000 random examples and they were all right from the previous day's join. And that's when I started reading more about it myself. But it wasn't hardware help, but it was essentially an algorithm that distributed the processing, that instead of going one row, it would send like batches of examples to do, and then assemble the data set when all of those batches were done. That was pretty groundbreaking technology that now everybody uses. But that's an example of like, so to take it back to like NVIDIA and Levels and what they're doing, databases traditionally operate on CPUs, but you could do it a lot faster on GPUs. And that's actually above my pay grade. I would have to actually research and know a lot more about exactly how Levels works. I do know it's faster. I imagine there's some like close match, maybe some compression. I'm actually interested, and I might ask because I do have a relationship with them. But it's almost always algorithms, not hardware, that is like making these companies, and that's what makes NVIDIA. You get to use their software that is actually embedded in the chip that makes you able to use that faster processing. And that's why everybody buys NVIDIA, because you could buy another chip, right? But then you need to duplicate all of that, like years and years of low-level programming, like to compete with that. And that's like embedded in the chip price. And even if NVIDIA chips are more expensive, they're not more expensive by any means than doing that yourself. Mm-hmm. And ironically, I think they have a higher price one now. I think like Magellan or something. But
I think
for a while, their best chips were called Teslas. And that's kind of fun.
Yeah, that is. So what I wanted to bring up also this week is I think Warner Bros might be one of the people watching our stream because we brought up streaming last week and the writer strike, and we were kind of spitballing about like how are none of these companies being massively affected by this? It's been going on for a while, and then right after we talked about that last week, Warner Bros comes out and says they're going to have a 300 to 500 million dollar negative impact to their EBITDA going forward from this, and if they're gonna have that, I'm assuming Disney will probably have more, and at least we have our answer now about the streaming stocks. It's gonna get
Well,
ugly.
well, one thing that's like really funny is that like just a quick thing on Disney and Bob Iger, who I actually like. I don't think he's doing a particularly good job this time around. Maybe it's passed him by a little bit. But he's like coming out and like dissing the the strike for like pulling their labor and doing that, like talking about it as like, dissing it as a negotiation tactic or like whatever. And then he just pulled like ESPN and all this stuff from like Spectrum. So it's like so funny, the hypocrisy of that. And like I do like obviously I've said like the strike a little bit. There are some things that I think there's been some hypocritical comments on like both sides, but it's all just like it's all political theater basically. So whatever. But it is really funny that Bob Iger like is like dissing on these uh, strikers, and then it's just like using the exact same tactic that he's like talking about too. And it's like, by the way, like Spectrum is a horrendous company. Like I'm sure the negotiation was awful on both sides, but it is really funny that he's just like sitting there like dissing them, and then dissing like the writer strike and basically using the same tactic himself, which is obviously like a traditional business thing. But no, like it's amazing that more people are not like grading these companies down. Like it is a serious problem for sure. Like absolutely no doubt like that this is occurring. Um and like yeah, you could assume about that for like any of these companies. I don't think Warner Brothers like I would have to do a much deeper dive to like say like who like I mean the one thing just like really like I'd have to look at like all of these conglomerates are like so big. The one thing that you might be able to like get by a little more on are um companies that rely more on like live things, right? Like I like a guilty pleasure of mine, even not even that guilty. I watch a lot of like 90 Day Fiance with my sister and like stuff like that, like where you're looking at like it's Warner Brothers Discovery. So like obviously you really have to do a deep dive on this to understand. But like companies that like that don't really have writers, like they do a little bit, and there's like all this speculation. But like I think the live shows they might be able to like even get away and be like, oh, we might normally have writers, but whatever, we're just gonna let these people say whatever they want. We're gonna go real reality TV. That's the one thing that if you might want to look for value, you might want to say, oh, they're hurting all of these like companies, but like this company actually leans a lot more on reality, live programming, like that kind of thing. Like even something like I think Fox sold, like Fox is getting hit, but I think they sold part of like one of their divisions that does I'd have to look more into that. But like yeah, like news programs, like that is one thing. Although I don't know, yeah, they still have live news. But yeah,
And
like
an
sorry, go
interesting
ahead.
thought just popped in my head is like, so Google is so big, it's like YouTube is almost an afterthought, but they have no trouble with a writer strike. I mean, all of their creators are basically just independent people. And now they have the NFL Sunday package, I believe, which is starting. So I wonder if they'll try to push for more. I don't know. I feel like YouTube is so big, they have viewers already, but I wonder if they can push it more somehow to try and take advantage.
It might be an opportunity for
Yeah.
sure. Like no doubt it might be an opportunity. Like I think that I think if there's like a content hole, but like I think Netflix is already on. I mean, who knows? They're just like pumping it out anyway.
Hmm.
But yeah, like I definitely think that like it's good for YouTube. It's good for short form content. I think you might like have just like it's already going that way. You might have people stepping away from their like TVs and more onto their phones.
Social media.
Like
Yeah.
if that content quality goes down because there's already a shift there. So I
Hmm.
think that that's like a huge like that's why I really think both sides like and who like I don't know enough about the negotiation. Like maybe it's like, but But I think like these companies that are just like, oh, business is changing, we need to be profitable. Like they might be missing that. Like this is like there was a baseball strike in the 90s, and like you might be fighting for a little extra profit, but it took baseball years to come back from that, and there wasn't like a perfect substitute good for that. Like baseball, especially, it runs at a time in a season where there's not really much other sports. So like even then, people were just like not even being like, oh, I'm just going to watch another sport. They were like, no, I'm not watching baseball. And I do think that like I do think we could have some of that for sure. Where like people are just like, if it goes that far, people are like, no, I don't want to like watch, like especially like if it gets worse, like no, I don't want to watch network stuff anymore. Like I'll just watch short form stuff because like I don't like it and it's not even around and the quality's falling.
Yeah, it's crazy how all these like Amazon, Apple, Google, they all have their own streaming play. But speaking of Apple, they have an event, I believe a week from today, September 12th, and they'll probably launch or show the new iPhone 15. And I don't know if they're planning to show like things about the headset or if this is supposed to be some grand unveiling. But do you think the Apple events are bullish or bearish, or do you think they're sell the news, or do you have any opinion on them?
I mean, I used to like in the Jobs days, like those were must see TV. Like, and like I'm saying, like I wouldn't rule them out, but like I haven't seen that next like big innovation, right? But the headset, like I think it's super cool. Like the price point, it's like very hard to get. Like that's my main issue with it, to get excited as a business opportunity with that big of a price point. But like I hope they make another groundbreaking thing. It looks really cool. It looks like something that could really help your work, and it's like a work tool. So I would be very excited. And I think if they unveil and have like a cool demo for that, their stock will like rocket. But the flip side is if it's just a new iPhone and some people are even maybe anticipating the headset and it's not there, like I don't think that's going to go well for them.
What if they drop the Apple Car? That'd be sick.
That would be.
I hope
And
so.
Tesla, if they drop the Apple Car, that would be a bad day for Tesla.
Oh, I didn't even think of that.
Yeah,
Yeah, you're probably right.
that would be a good day for them, a bad day for Tesla. But I think all car companies, like that would be a bad day. But Tesla especially, like if they demo an Apple Car, like get the F out. I'll be like selling the newsletter, like get out of Tesla, like immediately. Like, because I think that's like a 20% drop in 24 hours. And I'm not saying it's like a legit threat or anything, and like Tesla's not going to come back, but like there's going to be a hit when they because like like Tesla is that like experience, that design that like Apple kind of mastered. And especially if it looks cooler and it's got like more gadgets in it, everything, like that will be a bad day for Tesla stock.
Hmm. Yeah, now the only thing would be like, I guess we're like on board. Is Apple making a car? Like I've heard rumors. Like, is it gonna happen one day? It's just a matter of time, or is it just
The way it goes with Apple products is like like I'm sure and I think I've read this, they've acknowledged that they're looking into it. But they do a lot of art, like they're a design, like I'm sure they're working on the design. I'm sure they're like thinking about it. They're a huge company sitting on like a mountain of cash. Like them doing some R&D on a car and figuring out if they can make a product is very different than them announcing they're going to make a product. And I do not think they've done that, but I think it's kind of like the kind of thing where like it leaks, they acknowledge that they're looking at it. Like that's what I don't know 100% that that's true, but yeah. And that doesn't hurt them. They love to just be like, I'm sure they love to be like, they're looking at it, but yeah.
Yeah, so we're getting to the end of the time. I have a few more topics. I don't know if you just want me to keep going or
Fire them quickly. I gotta and if we have any questions, I have like a hard stop at 11:40, but I would like to be a little earlier than that.
Okay, yeah. So I had just like macro questions. Like this is kind of a whole switch of topic, but we've never really talked about like gold and silver. I know a lot of older investors love that. Like they always want to have an allocation to that for safety. And I was wondering if you care about gold and silver at
Let's
all.
push that to next week. That's too long of what we have time for.
Yeah, I don't know about. I feel like these topics are all like the other one was like, could we have rate cuts by the end of the year?
That's an easy one. No, I don't think so. We could, but like, yeah, we were looking at the rates before. Like, there's in in December, they're forecasting a 5% chance of easing, like, and January 15. Like, I don't see much changing. Like, I did mention in the newsletter that I was just like, hey, if Powell didn't scare the market when he like turned pretty hawkish, like at Jackson Hole, then I don't think any of these Wednesday Fed speakers. I think if anything, they might, if they're less hawkish than him, they could be positive catalysts. But I think the ship has pretty much sailed on, like, especially with this extra bull run. And we've talked about it. Like, the biggest incentive to cut is if the market is getting hit too hard. And I don't even know, like, with this little bull run here, like, I don't even know if you get hit hard enough, like, unless we just have like a huge decline, that they would step in. And even then, I think we're late enough in the year that Powell would probably prefer to just like talk about cutting next year to help than say he's going to cut this year. I mean, right now they're still forecasting I just had it up. I'll pull it up again. I think there's like still forecasting like fifth. I don't want to speak on. They're still forecasting, yeah. September, they're forecasting a 95% chance of no change. But then the next 3 months, November, they're forecasting 42% hike. And December, 38% hike. So I do think there's a decent chance that we get one more hike. I mean, obviously much better than a decline, but yeah, that's where I'm at on that.
So it seems like a better setup though than what we had like the past 12 months where we had a high inflation and raising rates. Like at least now if there's a downturn, we can cut rates, which should boost things, right? So there's a little bit more of like a floor on how low we could go this time.
Yeah.
All right. So that's kind of the end of what I had written down for today. No questions so far this week.
Great. I gotta get a move on anyway.
All right. Okay, we'll see everybody back here. We're going to be back to Monday, I believe, next week. So see everybody then.
Yeah. Sorry if this was an inconvenience to anyone.
All right. See you
All
later.
right. Bye.